market update, June 2023. And what we're looking at right now is the basic sector and basic material sector. Um, Let me first say, too, total, our basket of stocks 61% above their 200-day, 68% above their 50-day, which I think is right in line with where I think we have been. You can kind of see here. So the 50-day really flat since April, right? Sort of trending down a little bit, but pretty much flat. It is up, however, from that October 2021. And then looking at the 200-day, same thing, pretty flat, trending slightly upward. And I'll say on par going back to October. And so when we see that, the 60, 70 range, I think that says that the market is, pretty flat. I think it is trending higher a bit right now, but it's definitely not at the top at all and nowhere near the bottom. All right, so let's take a look real quick. Basic materials, 75% above their 200, 75% above their 50, and that puts them higher than the rest of the market. And I don't think that's surprising at all, just because we know the inflation causes higher commodity prices, and all those basic materials are going to trend higher. However, we see that from May to June, it's cooled off quite a bit. So I'm really happy that we got out of Southern Copper when we did to realize those gains. All right, communications, 50% above their 200, 50% above their 50. That puts them below the rest of the market. Again, surprising. A lot of these communications companies are going to be consumer based, and we know that right now the consumer is kind of feeling it because of inflation, but also worries about recession. And we see for the last couple months, they've all been down on average. All right, cyclical, 83% above their 200, 50% above their 50. What this says to me is that the cyclical sector is much better than what it has been in the past, but not doing very well right now, which again makes a lot of sense. Um, my question, though, is going back to last year, we're talking about June 2022. What was it particularly about the cyclical sector that made it not as great as it is now? The only thing I can think of is that 2021 was a real boon for the cyclical sector, right? There was a lot of cash floating around. People had a lot of money and they were buying a lot of things. And I think that maybe the 2022 comparison to 2021 was not as great. And so now, even though we see this 83% above their 200-day, I don't think it necessarily means that the cyclical sector is doing just really good. I think it's just basically on par with where it was last year compared to 2021. Consumer defensive. This one is a bit surprising. Only 41% above their 200, 50% above their 50-day. With a war going on, you typically assume that the defensive companies, the military weapons type companies, are going to be making a lot of money, and those stocks are going to be doing very well. But obviously, that is not the case. I'm not quite sure why. Now, inside of this consumer defensive sector is not only military companies, but it's also um, cleaning supplies and Coca-Cola and things of these nature. So, there is a consumer aspect to this, and honestly, I think there's more consumer companies inside of this defensive sector than there are military companies. So we'll look at those individually and see if maybe there's a big difference. But again, I think this is everything to do with the consumer story right now, and the consumer is not doing awesome. All right, energy. A lot has been said about energy lately. Only 58% above their 200-day, but 95%, almost all of these companies are above their 50 day. And what that means is that the energy sector is doing really good right now. I always have conversations with people, and they always ask me, like, what's good right now? What company do I get into? Well, you got to break it down into sectors, right? Because different parts of the economy are going to perform differently. And so, as of now, we haven't finished going through all these sectors, but it looks like right now the energy sector is doing awesome. Now, does that mean it's going to continue to do awesome? Of course not, right? It just means that right now all the money is being made in the energy sector. All right, look at this. Financials. Financials doing even better. 97% of financial companies above their 200 day, a full 100% of them above their 50 day. So again, haven't finished going through all of these, but obviously the financial sector is doing much better right now than the energy sector. Again, does that mean that it's going to continue to happen that way? I don't think so. The other thing that's interesting about this is that we know that there has been a lot of news and a lot of stories surrounding some of these smaller banks that are going under and things of that nature. We know that right now we have what's called um, contango, where the um, longer dated government debt, right, is a lower interest rate than the current government debt. And so what that means is typically the banks will um, borrow money at the current rate and then loan it out at a longer dated rate. So right now it's hard for the banks to make money. Not only that, but consumers are wanting to get higher interest on their money that's in the bank. And the only way the bank can go out and make that money is if they make it either in the market, if they make it by selling loans at higher interest rates, or some sort of other investment, right? You could talk about maybe raising fees. It's like, what do you call it? NSF fees, right? Non-sufficient funds fees, or raising the fees on simply having an account with the bank to try to make up the difference between what you have to pay out in interest to a customer versus the money that you're making. And right now, we know that banks are cutting fees. There's always been, for the last 5 years or so, there's been this real problem with banks charging non-sufficient funds fees and doing all these, kind of undercover things to charge customers money for using the bank. And so all those fees are coming way down. And so right now, the only way that the bank can make money is if they make loans at higher interest rates than what they're paying out, or if they're able to go out and borrow money at a cheaper interest rate in order to pay out a higher interest rate. Um, and of course, they can go out and they can make money in the capital markets. They can go out and buy stocks and things of this nature. And so, you know, this number, 97%, 100%, I don't think that that remains. I really don't. It'll be interesting to see what happens over the next couple months. But as of right now, just based on the numbers, you would say that the money is being made right now in the financial sector. I just don't know if that's the case. And we'll see that here in a second. All right. Health sector, 29% above their 200 days, 71% above their 50 day. This is not the best, but not the worst currently. I mean, 71% above their 50 days is not a bad number. However, this 29% above their 200 day is not good at all. And so I have to imagine that right now, when you talk about, where the money is, it's obviously not in the health sector, but that also means that these companies are going to be really cheap too, because like I said, currently they're doing really well, but over the last year, not as well. And so maybe they'll do better going forward. All right, industrials, 60% above their 200, 90% above their 50. And so a lot like the health sector, again, this is a sector that's doing really well, but compared to, a longer term trend compared to last year, not so well. So some of these companies might be a bit cheaper and might actually perform better going forward because, you know, this 90% above their 50 is not going to continue, but it means that the companies are doing fairly well, just not as well as some of the other sectors. All right, real estate, 80% above 200-day, 90% above 50-day, doing really well. A full 30% better than the rest of the market. And so right now we're looking at energy, real estate, and the finance sector as where all the money is going. Technology. This is something that's been talked about quite a bit. Semiconductors, mega cap tech, and all these things. 67% above the 200, 67% above the 50. There's been a lot of conversation about AI and all this sort of thing. Just based on these numbers, technology isn't really where all the money is going. Um, but, 67, 67, 10% negative warming, it's not the worst performing sector right now, right? I've said before, and I do believe this. It's been said by others as well, is that technology really does kind of tell you where the consumer is, because for the most part, at least here in the States, right? When we feel good about the future, when we have money in our pockets and we don't mind spending it, typically we're going to spend it on technology. We're going to go out and we're going to get the newest TV. We're going to go out, we're going to get the newest phone. We're going to get the newest computers and all this sorts of thing. And right now, I don't think that's happening. There's always going to be some excitement about some new technology. Right now, that's AI. And so I'm sure that there's a lot of money going into maybe like some smaller cap AI companies, right? Because there's a lot of excitement and speculation going on. But the big guys, right? The companies that really control the market and um, um, really are the ones that give us all of our technology. There's not a lot of excitement going on right now. Just looking at the numbers, anyway, right? Utilities. This one is hard to figure out. This is probably the worst performing sector right now. Out of everything. Only 15% above their 200-day, only 8% above their 50-day. Um, I have to think that this has something to do with how well the utilities has performed over the last year or so. And so this is just maybe it's just not as great as it was. Um, Again, utilities is a consumer story, you know. The thing is, though, is that for the most part, if you have a bill to pay and you have money in your pocket, you're probably going to pay your utility bill before you do anything else, right? I mean, it's hard to imagine people spending money on travel or spending money on luxury items before they pay utility bills. But as of right now, this sector is just not very exciting. It looks like there's a lot of money coming out of it. You see here is down -4%, down almost a percent. Let's pull this out a little further. See just kind of what's been happening. Here we go. So yeah, I mean, this is the utility sector, and you see a lot of negative numbers here. A lot. So yeah, so going back to 2021, I think maybe we see some big swings, some big positive numbers, but yeah, definitely over the last 6 months or so, it's all been kind of downhill. Um, so let's take a look now at some of these individual companies, see what's going here. I'm really Um, Curious to see what's going on, particularly in the consumer defensive. So this is basic materials. Southern Copper is where we were. Looks like they are the sector leading performer. And the NVP is really kind of spread out here. FMC, SCCO, RPM. Yeah. But we were definitely in the best, obviously. And we got out before this huge 11% drop, too. So really happy about that. All right. Communications. We know that this is not a great sector to be in right now. Again, the MVPs kind of spread out, and I think that's been the story probably over the last 4 or 5 months with a lot of these sectors. But the sector leading performer, I mean, they're all down. They're all down. But it is this CMCSA and Rogers, which is where we are now. So happy about being in one of the better performing companies in this sector. Lumen, which has been horrible since I started covering them, on average is losing 13% a month. That's crazy. And somehow, and I talked about this before, somehow Lumen still winds up in some of the better performing portfolios. But what I re- what I found out was that looking at those portfolios, the reason why Lumen tends to be in the better performing portfolios is because Lumen is typically the last um, uh, company to get chose for those portfolios, meaning that there's less shares in that portfolio. So most of these portfolios that are better performing may only have one share of Lumen. So even though it has horrible performance, it isn't affecting those portfolios as much as, let's say, Para is at maybe, half the value or a quarter of the value of the portfolio, right? All right, consumer cyclical. Looks like Starbucks is the nope. Lynn, LEN, um, is the sector leading performer. Don't know a lot about the company, honestly. Starbucks, I can definitely talk about, and it's also one of the MVPs. And I think that says a lot because Starbucks is, I mean, I may be wrong about this, but I think Starbucks is still like a luxury product, is it not? I mean, it's hard for me to imagine Starbucks being something like a Coca-Cola or something that you just have to have, you know. And it's again, we know that this is a consumer story, and we know that the consumer is not doing awesome right now. But I think that Starbucks probably has more of a pull on, like I said, more of that defensive stuff, right? Like a Coca-Cola, where it's just something that isn't going anywhere anytime soon. So that's really interesting. IPG is where we are, which is media advertising, not doing bad. 186 versus the 2.5, almost 3% of these other guys. GPC, which is a company that I love following, is at 1%, and then Yum Brands, all that fast food, is average 1% a month. So consumer cyclical, again, looking at these numbers, uh, isn't doing horrible at all. All right, consumer defensive, and so we see Target right away is the sector leading MVP, followed by Coca-Cola, which is where we are currently, losing, almost 1% a month. It's not great. Sector leading performer looks like GIS. Yeah, GIS. Um, Altria cigarettes, they're down as well. And so I'm looking now for those military um, companies, and I don't see any. All these are products. Campbell Soup, yeah, they're all products. So there you go. That's exactly why, I talked about being that there's a war on, you'd expect to see some of these companies doing well, but that's just not the case because none of them in this basket of stock. Okay, so Target, yeah, Target coming way back. Heard a lot about Target recently, but sector leading MVP just because I do think that it is a great company doing great things, and it did so well over the last couple of years, especially during COVID. But it's definitely coming back. So, is it a good company at a cheaper price? We'll see. All right. Energy. And we know energy is doing well. Again, the MVP is really spread out. And to me, that just means that, you know, every month is a crapshoot about, which direction the market is going. And we'll talk a little bit about that in a second, but, it looks like you can really just pick any of these guys and they're going to give you about the same performance. But the sector leading performer in the energy sector, which we talked about doing so well, doesn't look good looking at these individual numbers here, right? I mean, MMP is the only one that's really positive. Energy Transfer is positive, ExxonMobil is positive, MPC is positive, but barely. And so, yeah, energy is, to me, it's not where you want to be. And if you're going to be in energy, then you definitely want to go with something like an MMP, right? Or maybe an ExxonMobil. All right, banking, financial services, CG, Blackstone's always in the mix. IVZ we've talked about before, but again, everything is really spread out as far as the MVP is concerned. It means every single month there's going to be a different portfolio type that is besting the others. Looks like insurance though is where you want to go in this sector. So we got APO, we got Aflac, JP Morgan, barely positive, uh, Manual Life, Sun Life, fairly positive. Most of the banks, except for um, except for J.P. Morgan, are all negative. MetLife, Prudential, which is also insurance, are really down. Not sure why. So that's interesting. Key Bank way down, and so I think obviously J.P. Morgan is J.P. Morgan. They are America's bank, and so that kind of makes sense. Um, but some of these other guys, like I can't imagine why um, some of these insurance companies are not doing well, like Allstate. Like, what's up with Allstate? What's up with MetLife? Um, you know, MetLife maybe it's a consumer thing because, typically when I think about MetLife, I think about life insurance. And if someone doesn't have a lot of extra cash, they probably aren't buying any life insurance policy. So maybe that has something to do with it. But either way, we are in regions which I'll say it's probably just in the middle of the pack. All right, look at healthcare. DGX, kind of hard to call that the sector MVP. Like again, it's really spread out. Sector leading performer is Cardinal Health. I think that's been the case for a while now. We were recently in Merck, which is probably second place. The rest of these guys, all negative, and so don't really know what to say about that. Pfizer, which has been really in a battle with Merck since COVID, honestly, looks like it's losing that battle right now. But yeah, Cardinal Health definitely. I mean, just blowing everyone out of it. All right, industrials. All right, industrials. Fastenal, um, sector leading MVP again, barely. Um, really split amongst all these guys. Um, Paychecks is where we are, barely negative. Raytheon, military, barely positive. Let's see if I find any other military in here. No. So again, kind of a mixed bag, but you see a lot of negative numbers in here. Triple M, which is a lot of tape and nails and whatnot, way down. Real estate. All right, sector leading MVP for sure. KIM said their name quite a bit over the last year, but not performing very well. Looks like Macerich, which is malls actually, is fairly positive and almost sector leading performer. I mean, matter of fact, I'm going to say, yeah, sector leading performer, which is really interesting because Macerich has not done well at all for a long time. And for whatever reason, all of a sudden, coming coming about. Um, the MPW is where we are, and as you can see, it has not done well at all. Matter of fact, it is the worst performing company in the sector. There's a lot of reasons for that. VXP, I think, is probably a little worse, but either way, that's where we are. But last analysis, it's done really well. So we'll continue to monitor it and see what happens here. All right, technology, Corning, tech leading MVP by far. This is where we are. Negative, barely negative. Oracle, sector leading performer. Um, Oracle is corporate software, so that's interesting to see that. Intel had a lot of news and stories there. Has not done well for a long time and continues to struggle. Cisco again, corporate software, and so I think maybe that says the big corporations are doing better than the consumer right now. Same thing with Hewlett Packard. This is definitely more a consumer story than it is big corporations. All right, and then utilities. Again, MVP really spread out, and the sector leading performer looks like they're all negative. My goodness, yeah. So utilities is not where you want to be right now. We're currently in ETR. Where is that? Okay, so yeah, negative 143, which is really in the middle of the pack with the rest of these guys. But it looks like, yeah, ATO, barely positive. So to call that the sector leading performer is hard to do, but it is. The EIX and some of these others, which are barely negative. So let's take a look at exactly what what portfolios are performing the best. Um, right now, make sure I got that right. Yeah, right now it is actually the beta portfolio, and that is a portfolio that performs well when the market is not, right? And so this is counting dividends, and this is also going back to July of 2021, as you can see, talking about uh, 2 years basically worth of performance. Um, and then even I think if we look at just price performance, not counting dividends, the beta portfolio is still at the top. Let's go back to the overall standard deviation is where we are, and we can see it's right at about 2%. So still top five, and so I think we did really good with that portfolio this year, even though it meant um, having a lower risk profile and not having those really outsized gains. Obviously, it's done well um, compared to the rest of these guys. And then again, just looking at price performance, not counting any sort of dividends or anything like that. Of course, alpha is going to be there. Those are companies that perform well when the market's performing well. It's in the top five. We see some more alpha, but then again, we see that this beta at the top. And this is different. The last time that I recorded this, the beta portfolios were not the best performance. And that says a lot about kind of where the market when you talk about recession, when you talk about a market dropping, the beta companies is where you want to be, right? Um, we see a lot of return alpha in here, return standard deviation, alpha, return. So, yeah, I mean, when you see beta and alpha and return all at the top, And what that means to me is that you have a market that is very divided, right? You're either making money when the market is dropping, or you're making money when the market is running up. It's doing one or two things. It's not, it's not doing anything in the middle. But you do see standard deviation kind of in here as well, which will work well when the market is kind of in. So yeah, just really up and down right now. I think over the last year anyway. Okay, so this is the low and high is really kind of a risk profile. So the lowest risk um, the lowest risk portfolio, as you can see, standard deviation, which is typical. We see a lot of down moves, a lot of M score. We talked about that before. Uh, this dividend portfolio. And if you want to talk about high risk, right? High risk, we see some of these alphas, see a little bit of beta in here, right? Some beta down here. And so this is the most you can lose on any given month, right? You see 13% versus when we go to the best, it's 7. So it's almost half, right? And then on the other end of the spectrum, when we talk about, again, risk profile, this is the lowest. It's hard for me to say that grammatically, right? This is the lowest gain that you could see month to month, okay? The lowest. And so we see, again, some standard deviation stuff in here. There's a lot of M score. Uh, there's a few dividend portfolios in here. And then if we go the opposite direction and look at the largest gain that you can see month to month, it's again almost doubled at 12%. But one thing that I want to bring up very quickly here is that you see these portfolios, right? This high risk profile. You stand to lose more than you win again here, even though it's almost even, you still stand to lose more than you win. Same here. This one is again fairly even, but again, right back to you lose more than what you win. And so that's what you are thinking about when you think about risk profile. You want to make a lot of money, right? You want to have these outsized gains, but you cannot do that without having an outsized loss. So if we go back and look at what the standard deviation portfolio has done, you see it is almost even, but you stand to gain more than what you lose. And I don't know if I can find one that's better than that, honestly. I'm going to scroll through and see if I can. 8 and 11, 9, 12. All these are like double digits. Yeah, that's it. Yeah. I mean, like I say, this dividend and down is probably the closest thing to this standard deviation. And so again, we didn't beat our bench this year, and I think that has a lot to do with the fact that we were in this low risk profile portfolio. But again, I rather have the ability to gain more than what I lose, especially when we know that we're looking at a market that is so obviously up and down. I mean, these two portfolios are the exact opposite of each other. And over the last couple months, I've seen this change, right? The beta has never been at the top. This is brand new that the beta is at the top. Usually it's like an alpha or something like that. And standard deviation was always like top 10. And now we see standard deviation is kind of way down here over the last month or two. So, you know, that's just that's the game. But I am happy with where we are, and really excited to see what we come up with the next um, uh, with the next um, basket of stocks. Looking at our heat map, um, this is last month, and we see last month all the portfolios lost money. The dark green are the ones that lost the least, and of course, dark red lost the most. And so, yeah, the alpha portfolio um, definitely. lost at least almost 2%. Standard deviation, kind of an olive green at 3%. But if we look at the colors of the alpha portfolio versus the colors of standard deviation, you notice that standard deviation portfolio is way more muted, right, than these darker, brighter reds and greens of the alpha portfolio. The beta portfolio, however, over the last year actually doesn't look that bad in comparison. Still much brighter than the standard deviation, but way more green in here. And so when we reshuffle everything and look at the numbers again, maybe that beta portfolio is where we'll end up. I don't know. It's hard to say right now that betting against the market is the way to go. But we have to follow the numbers. Numbers don't lie, and math is even better. We see a lot of other portfolios, I think, that are doing fairly well, and some that you just don't want to touch at all. So again, really excited to see what the next year brings us, and I'll be back to talk about it.